Hello, this is Dan Betzel, and I'm going to be your guide through this next investor coaching workshop series entitled Separating Myths from Truth, the Story of Investing. Now, before we get started with the actual workshop, I want to make sure that you understand that all investing involves risks and costs, and that anything we talk about during this workshop, you need to speak with a competent advisor, tax advisor, financial advisor who knows your personal situation and can help you choose the best philosophy and the best way to move forward. And that no investment strategy, including the one that I'm going to talk about today, including asset allocation and diversification strategies, can ensure peace of mind, guarantee profit, or protect against loss. So let's get started. And as I said, the name of this workshop is Separating Myths from Truth and the Story of Investing. So, our goal today is to dispel some investing myths and to tell the academic story of investing and to give you an opportunity to achieve true investing peace of mind. Again, there's no guarantees, but those are our goals today, and I think they're worthwhile goals and hopefully goals that you will find to be very helpful in moving forward with your financial planning. So, what is a myth? A myth is a story made up to explain a phenomenon beyond the science of the day. And let's look at some common investing myths. The first one is the myth of stock selection or stock picking. The second is the myth of track record investing. The third is the myth of market timing. And the fourth myth is the costs of investing. We'll look at each of these in greater detail. Let's begin with the myth of stock selection. So, the myth is that you can choosing stocks based on a belief that they will do well in the future. And the myth is that there's investment advisors who can consistently and predictably add value through individual stock selections. And the key to this is it's not that you can find some anecdotal evidence where a specific advisor or firm in the past has been able to choose a stock that did well then in the future. But the myth is that these advisors can consistently and predictably add value through individual stock selection. There's something that's very interesting that a lot of individual investors are not aware of. It's called survivorship bias. I know this graph is kind of busy, but if you look at it, you can see that back in 1923 we had one mutual fund, and that was all that was created that year, and there were none that were actually killed off or that were killed off, I guess, is the best word. But as you can see, going through the decades from 23 to the 40s to the 50s, when you get closer to our current day, I mean, look at the numbers beginning like, for example, 1989 and 2000 and 2008. You can see that we have ever more increasing number of funds, mutual funds to choose from, and we're always opening up new funds and we're closing funds. Why would a mutual fund company open up new funds and close funds and merge old funds into new funds? Well, they do it in order to improve the track record of a specific fund. So if a specific fund is not doing very well, it can be closed or it can be merged into a new fund and or to an existing fund that is doing well, and then that particular fund can report a better rate of return. And these numbers on this particular screen, if you want to do any more research, you can find additional information at the Center for Research and Stock Pricing. But here's what's fascinating. So, as of 2013, there were actually 30,586 funds, and but 54,364 funds had actually been created, and the various mutual fund companies had actually killed off or merged 23,778 funds. So you can see there's this issue called survivorship bias. And survivorship bias skews often the information we're looking at. And unless we're aware of that, we don't know the right questions to ask, and we may feel or may think that a mutual fund actually has a better performance record than in reality it has if you were able to look at the survivorship bias funds. So this is interesting. The worst 200 dead mutual funds, can you believe it? A negative 79.58 average cumulative return. That, of course, is why we have funds being killed off and merged with other funds. This is a very interesting chart graph here. The blue line represents the average mutual fund. So if someone's participating in an average mutual fund that's being actively managed, in other words, they're paying to have this fund managed, and you're comparing it just with the S&P 500, or you're comparing it just with the Center for Research and Stock Pricing market, you can see that the blue line actually is underperforming the S&P 500. Now, if that particular money manager were adding real additional value, then the active money manager, then you would expect then that that blue line would be above the S&P 500 index. So, active potential wealth loss to active stock management in this particular example is over $2 million. But the interesting point to note is that the average mutual fund actually underperforms the S&P 500. Now, if we looked at all mutual funds versus hypothetical sample asset classes, we can look at all mutual funds, of course, then the aggressive, growth, moderate, and conservative. Myth two is track record investing. What is track record investing? Track record investing is the use of performance history to determine the best investments for the future. So, this belief is something akin to you're driving a car and you're looking in the rear view mirror to try to determine where you're going to go. Of course, we'd all say, as far as driving a car is concerned, that's very reckless and dangerous. So the myth is that finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. And if we look at the track record investing U.S. equity funds and we compare two 10-year periods, for example, from 1994 to 2003 as one 10-year sample, and then 2004 to 2013 as our second-year sample, you can see here that the top 30 U.S. equity funds average annual return for 1994 to 2003 was 17.38. Now, those funds did, for that particular period, they did outperform the U.S. All U.S. equity funds average annual return of 8.57, as well as the average annual return 11.07 for the S&P 500. So what happens here, of course, is that advisors, individual investors are looking back at this 10-year period and they're saying these are the funds that we should invest in. So a lot of investors never participated in the funds during this 10-year period, but they jump into the funds at the end of the 10-year period because of their track record. Well, let's look what happened the next 10 years going forward. So those particular funds, the top 30 funds for the 94 to 2003 period, now you can see for the next 10-year period, 2004 to 2013, they actually underperformed all U.S. equity funds and underperformed slightly the S&P 500. What's very interesting to note is the amount of actual funds that were in existence. So from 1994 to 2003, we see there were 1,650 funds, individual funds, and then from 2004 to 2013, over 4,000. So you have to ask yourself, why would there be this large proliferation of mutual funds going forward? So track record investing U.S. equity funds. Some people say, well, that's a long period. Let's look at a 5-year period, and we can see the exact same result happening for a 5-year period. So from 2004 to 2008, the top U.S. equity funds annual return was 4.58, and yes, they certainly did better during that period than the all U.S. equity funds as well as S&P 500. But if you look at the next 5-year period, 2009 to 2013, then those funds that had done so well in the previous 5-year period, they still had a return, an acceptable return of 6.24, but now compare it to all U.S. equity funds. So chasing returns can be very problematic, and it can actually undermine your long-term financial goals. So a manager's ability to pick stocks in the past has little to no correlation with his or her ability to do so consistently in the future. And this is the truth, um, that dispels the myth of track record investing. So, what about market timing? Well, what is market timing? Market timing is any attempt to alter or change the mix of assets based on a prediction or forecast about the future. Once again, it entails that someone is looking into the future and trying to determine what's going to happen. So the myth is that money managers are able to utilize market timing to effectively predict up and down markets. Now, the Dalbar research study and shows a very, very fascinating chart. So the S&P 500 index. Now the S&P 500 is America's largest 500 companies, companies that you're familiar with, and that you would know the names of. And between 84 and 2013, the S&P 500 had a great return, 11.1. Yet the Dalbar average investor, equity fund investor, only had a return of 3.69. So when you take out the CPI, representing inflation, then you see a very, very low real rate of return. But how can this be that if the S&P 500 did so well during that period, why do we find the average equity investor underperforming the market at such a dramatic decrease? Well, it has to do with the myths that we're talking about. This is an example why market timing doesn't work. So here's the growth of a $10,000 investment between July 1st, 93 and June 30th, 2013, a 10-year period. So there are 5,040 actual trading days. So if you had stayed invested the entire time, you can see that you would have that $10,000 investment would have grown in excess of 50,000. If you miss just the top 10 days, 20 days, or 30 days out of 5,040 trading days, you can see what happens to your return, how it's greatly diminished. And the trouble with market timing is you have to be right twice. You have to know when to get out of the market and when to get back in the market, as opposed to just staying the course, staying invested, and you can see the result of the various portfolio values at the end of the 10-year period. Now, some people say, you know, well, I agree that market timing really is not a prudent way to move forward with my investment strategy, but we don't really do market timing. We do tactical asset allocation. So tactical asset allocation is a it's shifting among multiple asset classes based on the market outlook. It is every bit market timing that we've been talking about. It's just that it's disguised and a little more complicated, and some could argue that it's actually even more problematic and could cause more problems to your portfolio. Now, Charles Ellis, he writes a great book. Recommend that you read it. It's a very short read and easy read. His investment policy, How to Win the Loser's Game, in 1993. And he says, somewhat tongue-in-cheek, the evidence on investment managers' success with market timing, it's impressive and overwhelmingly negative. So, let's look at the fourth myth. The fourth myth, costs of investing. Some people feel that, well, what you don't know can't hurt you. But the truth is, what you don't know really can hurt your portfolio. So costs of investing are fees incurred by investors to buy, sell, and own stocks or mutual funds. The myth is what you don't see can't hurt you. So there's costs of investing. There is a cost that it's not hidden if you know where to look for it, but it certainly is not something that's easily seen from most statements. But is in the prospectus and it also can be found online, is the bid-ask spread. Basically, what this means is that when you buy or sell anything, it's going to be bought at one price and sold at another. For example, if I have a car and I want to sell it to a car dealer, they're going to buy it from me at one price and they're going to turn around and sell it at the higher price to the next person who comes in and wants to buy that car. So the difference between what they buy it from me and what they sell it for is the bid ask spread. So if you have an actively managed portfolio that the manager is buying and selling stock, that can become a drain on your portfolio because of the bid ask spread every time they buy and then turn around or sell and turn around and buy another stock. And there's also just internal mutual fund expenses you need to be aware of. So what is the bid-ask spread? As I was explaining, it is the spread between the sale price and the buy price. In this example, we have stocks selling for 49.50 and you're buying it at 50 and the market maker gets the spread. Doesn't sound like very much, but it can add up when you have actively managed portfolios. So this is just really interesting chart. I'm not going to go into a lot of detail on it. It just shows that if you're trying to invest in smaller cap stock funds, that the actual costs to participate in that particular asset class is can be high. And if you can see, for example, if we have market cap range in millions between 50 and 200 million and market cap at 0.2%, we can see the actual spread is 1.34. That can really be 1.34% can be very, very expensive to your portfolio's performance. So the bid-ask equity spread costs you may not see. The bid-ask spread as a percent of price, it's an estimate of actual trading costs. And as we just saw on the graph on the previous screen, this estimate is over 30 times as great for the smallest market segment as for the largest market segment. 1.34 versus 0.04. It's really interesting, and one of the things that an investor has to do has to become very knowledgeable of the costs and find ways to lower or mitigate those costs. If you could just cut out 1% of costs, that would translate into an immediate 1% additional return for you and your family. So consumer no-load mutual funds. The key question under the new rules of the game is this: how much better must the active manager be to at least recover the costs of active management of this bid-ask spread? And as Charles D. Ellis said, the answer is daunting. So far, we talked about the myths: stock selection, track record investing, market timing, and costs of investing. I hope you found that interesting, at least give you some interesting things to think about. Next, we're going to look at an academic approach to investing that doesn't participate in stock selection, track record investing, market timing. Of course, there are costs with any investment philosophy, and you really need to be careful that you compare the costs and make sure that it is the best for you and your family moving forward. So, the story of investing. We're going to talk about modern portfolio theory and give you some background information as well as an example. So, what is the free market portfolio theory? What is it? And I'm going to be speaking about a specific interpretation of that from Matson Money. And there'll be a lot more information about this particular philosophy as we go through. So, free market portfolio theory is an investment approach based on 50 years of sound academic investing and accepted financial theories. It's a disciplined approach that seeks to capture market returns while managing volatility. This is crucial. We're not trying to beat the market. We're not trying to outperform the market. We're just trying to capture market returns. There's three components to the Matson's free market portfolio theory. There's component number one: free markets work. Component number two: the modern portfolio theory itself, which we'll explain. And then component number three is the three-factor model, which I think you'll find very interesting. So leading academics whose ideas form the basis for Matson's free market portfolio theory: Harry Markowitz, he won the Nobel Prize in 1990, professor of University of Chicago. Merton Miller also won the Nobel Prize and also professor at University of Chicago. Rex Sinquefield, you may have heard about him, co-author of Stocks, Bonds, Bills, and Inflation. He has an MBA from the University of Chicago. Again, these are academics. And Robert Ibbotson, you may have heard of Ibbotson. There's actual actual uh, the he's written a lot of articles, and he's written um, several books. You can see some of the lists of what he's written here. Um, Professor at Yale. Eugene Fama, University of Chicago, and French. Now, Eugene Fama just recently, this last year, won a Nobel Prize in economics. And these are the academics that form whose ideas form the basis for our approach to free market portfolio theory. So, component number one, free markets work. In a free market, at any point in time, the actual price of a security will be a good estimate of its intrinsic value. Now, this is very, very profound, and if you carry it out to its logical conclusions, it will have a very dramatic effect on your investment philosophy. So, this is a quote by Fama taken from the book Random Walks in Stock Market Prices. So, in a free market, at any time, the actual price of a security will be a good estimate of its intrinsic value. What this means is that all the knowledge that's already knowable has been factored into the price of the stock, and only information that's not knowable, um, that we call news because it's new, that information, of course, has not been factored into the price, and it won't be factored in until there's some additional information that causes the market to reassess the price. So a potential belief would be that free markets fail. And what this means is that the market fails to price goods and services efficiently, and it's possible for some individuals to identify in advance which prices are inaccurate. And underpriced or undervalued markets can be forecasted or predicted, and managers seek to increase returns and avoid losses by taking advantage of these stock or market mispricings. And if this is your philosophy, then that's fine. You just need to be able to know your philosophy, be able to articulate it. And then if this is your philosophy, you should use the traditional investment approaches. Now, on the other hand, an alternative belief or an alternate belief would be that free markets work. In other words, that free market is the best determinant of market prices based on supply and demand, and all available information is already factored into the current price, and only new and unknowable information and events can change pricing. And the randomness of the market makes it impossible for any individual or entity to consistently predict market movements and capture additional returns, and this is extremely important, unrelated to risk. So if you are engaged in a investment philosophy that is seeking to outperform the market to beat market returns, you have to ask yourself, what is the additional risk that I'm taking in this strategy, and is it worth it? So people that have this belief that free markets work, they would utilize free market investment strategies, which we're going to talk about and illustrate here in a few minutes. Now, beliefs dictate action. So either free markets work and you're going to focus on capturing market returns, you're going to eliminate traditional investment strategies, you're going to utilize asset class or structured funds, you're going to diversify prudently, you're going to be able to identify your risk tolerance, and you're going to work with someone who shares your market belief and helps you pursue your investment objectives. Or you'd believe that free markets fail, in other words, that um, they don't price stocks efficiently, and you're going to focus on active management. You're going to pursue traditional investment strategies, and you're going to stay connected. You're going to want to stay connected to multiple sources of financial information, read as much market information as you can, and you're going to want to work with someone who shares this belief so that you'll be able to effectively come up with a plan or a strategy that would follow your beliefs. Now, Matson component number two. Modern portfolio theory, diversification works, based on the Nobel Prize winning work of Markowitz, Sharp, and Miller. So, Dr. Harry Markowitz, he's a graduate student in economics at the University of Chicago in the 1950s, and he won acclaim for his studies on portfolio design and risk reduction. And these concepts were later crucial for the development of modern portfolio theory. This is the Markowitz efficient frontier, and my guess is many of you have seen this before. It's extremely useful in determining whether a portfolio is efficient or not. So, on the on the two axis, you can see that 1 year standard deviation, which is just another word for volatility or risk. And you can see the annualized compound return expressed in a percentage. So this efficient frontier allows us to take a person's portfolio and to enter the data into a system, a computer program, and to plot where that particular portfolio falls on the efficient frontier. Now, as an example, you can see the S&P 500. Now, the S&P 500 has a very nice historical rate of return, above 10%. Who would not be happy with that? But look at the amount of risk or volatility. It's slightly in excess of 18. So if you had a portfolio that was um, investing only in S&P 500 excuse me, positions, equity positions, you would have a couple choices. You probably would have to ask yourself, well, if I can live with that much risk, greater than 18% standard deviation, why don't I reorient my portfolio and push it up to the efficient frontier and increase my return from slightly over 10 to closer to 13? Or if I'm happy with that return, I could also march the portfolio by reallocation down to where it would have the same return, slightly above 10, and I would move slightly to the left of a modern portfolio, or I'm sorry, a moderate portfolio, and I'd be able to cut my risk dramatically. So it's a great tool for looking at the efficiency of a portfolio and how much risk, and helping the client get clear about where they would like to find themselves on that efficient frontier. Now, there are fascinating analysis and studies that have been done. This is the determinants of portfolio performance taken from the Financial Analysis Journal, and you can see that market timing, when we look at a portfolio's performance, is about 1.8%. There's other factors, that kind of fudge factors, that can be added to any of the other determinants of portfolio performance. Stock selection 4.6. But here's what I want to show, is that 91.5% of portfolio performance is determined by asset allocations. That's where our focus and our attention should be, not on market timing, stock selection, and other factors. Now, in addition to when you design a portfolio, in addition to making sure that the portfolio is diversified, you also have to look at asset class correlation. Now, we know that some asset classes move in tandem or in step with other asset classes, and we know that some asset classes are not correlated. In other words, they don't move in step, and that's what we want. We want to have a portfolio that is not 100% correlated. So if you have all of your portfolio in one asset class like the S&P 500, well, that S&P 500, the majority of those stocks, the majority of the time, are going to move in tandem. So if one particular stock is experiencing some difficulty and is not performing well, chances are that the other stocks in that particular asset class will be following suit. So what you want to do is you want to build a portfolio that has various asset classes moving in dissimilar directions. The easiest example to look at is, most people understand that when stocks soar, bonds sag. And when bonds soar, stocks sag. So you want to design a portfolio, just in the simplest terms, that's going to have asset classes that are moving in different directions, so that when the equity markets are under pressure, then the bond market is doing better, and vice versa. It smooths the ride out, and it helps us suck out some of the risk of from a portfolio. So here's some examples of how we can use various asset classes to increase returns and reduce volatility, which of course are our goals. So an S&P 500 large U.S. stock has a nice annualized gross return of 10.4, but has a standard deviation or risk factor of 16.94. So we like the return, but what can we do? What asset classes can we add? Other asset classes can we diversify in such a way that we're going to actually lower our annualized standard deviation and raise our annualized gross return? Well, if we go 70% to S&P 500 and 30% into Europe and Far East, we can see what happens. We have a slight reduction in our standard deviation or risk and a slight increase in our annualized gross return. Now, this is just an example. It shows us slight returns, but if you were to actually design your own portfolio, you can dial in the amount of return and risk that you're willing to take. What if we add another asset class? We have our 70% S&P 500, 20% Europe and Far East, and 10% international small. Now this is interesting. We've now been able to increase our annualized gross return 11.06, and the annualized standard deviation has actually gone down even a little more. So potential to increase returns and reduce volatility by following this particular aspect of modern portfolio theory. Matson component number 3 is the three-factor model. It's the philosophy based on the analysis and research of Eugene Fama and Kenneth French. And the three-factor model has the market factor, the size factor, and the value factor. And we'll look at each of these briefly. So the market factor. Now, the market factor, what would you expect if you were going to compare the S&P 500, which is America's top 500 companies, with Treasury bills backed by the United States government? Which would you expect would have the higher return, and which would you expect would have the higher volatility? So, this first basic tenet is that equities are riskier than fixed income. But equities historically have provided a higher rate of return. And if we look at the sample here, from 1926 to 2013, S&P 500 gross return 10.08, and Treasury bills have only been 3.50. Now, if we look at the standard deviation or the risk, we can see that the S&P 500, of course, has a much higher standard deviation, much higher risk, and than the Treasury bills. And it's kind of like the front and the back of the hand. You can't separate them. Everybody wants S&P 500 returns for Treasury bill risks, but that's not how it works, right, in real life. If you want the higher return, you have to take higher risk. So the market factor just tells us that equities historically have performed at a higher rate of return, and correspondingly, there's also higher rate of risk. The size factors. So small companies are riskier than large companies. I think that all makes sense to us on an intuitive level. If you were going to invest in a small company, a startup company, or you're going to invest in Procter and Gamble, which would be riskier? Most would agree that the startup company would be riskier. But which would have the possible potential for greater growth if the company were to be successful? The startup company, well, probably the small company. I think we kind of understand that on an intuitive level. But so small companies historically have provided a higher rate of return than the large companies. Again, it's the same philosophy, the same idea, because there's this relationship between risk and return, risk and return. So here again, once again, we have the S&P 500 with its gross return of 10.08, standard deviation of 20.58, and we compare it to U.S. small company, and we have a higher rate of return, 11.74, but for that higher rate of return, we're going to be taking more risk. You can see the standard deviation jumps from 20.58 to 30.54. Now, the third factor is the value factor. High book-to-market value stocks are riskier than low book-to-market stocks. High book-to-market stocks historically have provided higher return than low book-to-market stocks. Again, it's the exact same philosophy that if you're going to take additional risk, you will be compensated for it with higher returns. And these three factors are crucial in designing and engineering a portfolio that is going to be best suited for an individual investor. So the academic approach, well, the belief system that free markets work, We talked about that. Do free markets work or do free markets fail? Modern portfolio theory, the efficient frontier, we talked about that. And of course, the three factor model, which we just finished discussing. Those three approaches put together are Matson's free market portfolio theory. Well, let's look at an example now. Can we build a better portfolio that doesn't utilize stock picking, track record investing, market timing, and is conscious of what we can do to keep the costs inside a portfolio lower? So we started earlier in this presentation talking about the Dalbar investor results, and the average equity investor, 100% equity mutual fund investment results, just in the S&P 500, if you're going to compare it. And look at this, from 1984 to 2013, the average equity investor only received an annualized return of 3.69, but the annualized standard deviation risk 17.75. Well, at the same time, the S&P 500 had a much higher return, annualized return of 11.10, and for actually a little bit less standard deviation. So why is it that the average equity investor appears to be underperforming just the S&P 500 index? Why? Well, the average holding period for an investor is only 3.31 years. They also engage in track record investing. They're chasing last year's hottest stocks and mutual funds, chasing the market. They're engaged in active stock picking and their market timing. So these are the investor behavioral actions that are actually undermining their ability to achieve market returns. Well, let's create a diversified portfolio, basic passively invested portfolio. So portfolio number one is just 100% in S&P 500. Annualized gross return is 10.4, and the standard deviation, just even doing that, puts an investor ahead of the average equity investor that we just looked at on the Dalbar study. But can we do anything to raise return and to lower risk? Well, portfolio number two. What if we had the S&P 500 index at 60%, 5-year government portfolio, 20% and 1-year fixed income? Now, most people would be okay with lowering their annualized return from 10.4 to 9.3 if they were also at the same time able to reduce their risk, their annualized standard deviation from 16.9 to 10.39. Let's keep going. What if we were to also add some Europe and Far East? Now we can see what's happening here. We're able to slightly raise the annualized gross return, and we're actually even able to lower the deviation or the risk just by a little bit as well. Now, if we're going to add some U.S. small and international small, we can see what's happened here. Portfolio number 4, annualized return of 10.5 and standard deviation of 11.3. Portfolio 5, we're adding some U.S. large cap value, and you can see what's happening in here. Again, the annualized gross return of 10.99 and the standard deviation of actually going down to 11.07. So the idea, what I want you to take from this is that we can create a portfolio that dials into your risk and return goals. Again, there's no guarantee, but we can use these philosophies to assist you in designing a portfolio that is efficient and that reflects, your investment philosophy and your risk and time factors and time horizon. So creating a free market fund portfolio, you can see the free market U.S. equity, free market fixed income, and the free market international equity. These graphs here just show us the various asset classes that are inside each of the funds that we've been talking about, the U.S. equity, international equity, and free market indexed income. So creating a well-diversified portfolio. This is what a well-diversified portfolio should look like. Now this is a hypothetical 60-40, so 60% in the equity, international and U.S. equity, and 40% in the fixed using diversified funds of funds. And you can just see here the various asset categories representing over 40 countries. And truly diversified portfolio would have an excess of 12,000 individual equity positions inside the portfolio. This is modern portfolio theory, diversification, shown in this graph. So I'd like to um, bring this to a conclusion by asking you to get a piece of paper and a pencil. And I'm going to go through the 20 must answer questions for your journey toward investing peace of mind. Now, you have to answer each question yes or no, and you have to be able to answer the question 100% yes to qualify as a yes. Now, don't feel bad if you can't answer these questions. The questions are not intended to make you feel bad. They're actually intended to help you understand the right questions to ask. Because I really believe that if you can ask the right questions, then you're going to be able to find the answers that you need in order to make the best decision for you and your family. The first question: have you discovered your true purpose for money, that which is more important than money itself? Now, we all know that money is not the most important thing in life, but can you truly say in just one word or a couple words your true purpose for money? And can you state it succinctly, and are you confident about it? If you can, say yes. If you can't, say no, and that's okay, because you'll be able to work on that at a later date. Are you invested in the market? Most people can answer yes to this because they're participating in their employee 401k, 403b. They may have a traditional IRA. So if you have any money in the market and you're invested in the market, you could answer yes to question number 2. Do you know how markets work? Now, we talked a little bit about that today. So, do you understand the modern portfolio theory? Do you understand the efficiencies that we talked about in the market? If you do, you can answer yes. If not, if you're still not clear, then maybe you need to answer no to that one. Have you defined your investment philosophy? We talked a little bit about that today. Do you believe that markets work, or do you believe that markets fail? And do you know why? And can you articulate it? Have you identified your personal risk tolerance? I don't mean that you say, well, I'm a conservative investor, or I think I'm an aggressive investor, but you should actually have an actual number, an actual standard deviation number that you understand and that your portfolio has been designed and is being managed based on that personal risk tolerance number. If you can say yes to that question, then write down yes. If not, write down no. Do you know how to measure diversification in your portfolio? Yes or no? Do you consistently and predictably achieve market returns, or is your portfolio underperforming the market, as we saw in some of the examples? Now, if you're not sure what market returns are, then you probably have to put no to this one. Have you measured the total amount of commissions and costs in your portfolio? Yes or no? Do you know where you fall on the Markowitz efficient frontier? That was the graph that I showed you with the efficient frontier and the S&P 500, which was inefficient because it was getting the nice return of a little over 10%, but it was taking too much risk for the return it was getting. So do you know where you fall on that Markowitz efficient frontier? When it comes to building your investment portfolio, question number 10, do you know exactly what you're doing and why? Yes or no? So we're halfway through the questions, and the goal again is not to make you feel bad, but it's to actually help you to know what steps you need to do, what questions you need to get answered in order to move forward. So let's go through the next 10. Are you working with a financial coach versus a financial planner? Another way of asking this question is, are you working with someone who shares your investment philosophy? And once you're clear about your investment philosophy, you just want to make sure you're working with someone who shares that philosophy with you. Number 12, do you have a customized lifelong game plan to guide all of your investing and spending decisions? Number 13, do you have an investment policy statement? If not, then you should. If you don't know what it is or you don't recall, then you should probably answer no to this question. Question number 14, have you devised a clear-cut method for measuring the success of your portfolio or failure of your portfolio? A lot of people open up their portfolio statement at the end of the quarter, and if it's gone up, they think it's working. If it's gone down, it's not working. that may not be the best way for you to determine the success or failure of your portfolio. There might be a better way. Question 15. Do you fully understand the implications and applications of diversification in your portfolio? We've talked a little bit about it today. There's a lot more that we could talk about, but have you given thought to that and how that impacts your current portfolio? Do you have a system to measure portfolio volatility? How much volatility is acceptable in your portfolio? Just like if you're the top of a very large building in New York or Chicago, it sways a little bit. If you've ever been in an airplane and sat by the window by the wings, you can see the wings. They go up and down a little bit. It's designed for that. Well, how much volatility is designed into your portfolio? Question 17. Are you aware of the costs associated with purchasing commission-based products? Not that they're all bad. They're not. There's some good ones. But are you aware of the costs? Question 18. I think everyone will be able to get a yes to this one. Do you know the three warning signs that you may be speculating with your money versus prudently investing it? We talked about them today. One is market timing, two is stock picking, and three is track record investing. Whenever you engage in market timing, stock picking, track record investing, you have to ask yourself, am I speculating with my money or am I prudently investing it? Question 19. Can you identify the cultural messages and personal mindsets about money that destroy your investing peace of mind? And the last question, which I think is probably the most important question, because embedded in this question is the ability for you to make changes and move forward. But are you ready to shift your personal experience of money and investing from a scarcity mode to an abundance mode, where you can live your life rather than obsess about your assets? Now, if you found this useful, I hope that you will continue in the series of upcoming investor education and coaching workshops. Also, be my pleasure to speak with you either through email or on the phone, whichever is more convenient to you. And but whatever you do, please make sure that you give these ideas some thought and that you speak with a competent financial advisor, tax advisor that you trust. So thank you again. It's been my pleasure to guide you through this particular workshop, and I'm looking forward to having you take another workshop with us or to contact me directly. Thank you again, and wish you a great remainder of your day and much success, personal and financial success for you and your family. Thank you.